Once again, good evening, everyone. My name is Yogesh. Thank you so much for coming today on this webinar on trading strategies for volatile markets. We have done a lot of such webinars in last few years, and especially in last few months, where the stock markets have taken a very dramatic turn, and a lot of investors have been asking the question, which are the good areas to invest, what should be the trading strategy for this kind of volatility, what has happened through the past, what's going on. And that's why we try to do these sessions to not only keep you updated, but also to have a mutual understanding of what's going on. A lot of times participants, they share their views on what's going on, so you have a small chat window. You can write your thoughts, your views, your questions, and I'll be trying to answer them in my fullest capacity. If there is something which I cannot answer, I'll definitely, someone from my team will reach you out and will definitely assist you with all your investment solutions, just like what Century Financial does. So if you can hear me clearly, if you can see my content, please give me a thumbs up or write it over the chat, yes or okay, so I can just have an idea that my voice is audible. My voice is audible, my content is available, you can see everything. I hope there should not be any problems. Please use your chat options, try it out. If it works well, give me a thumbs up. If you can hear me, write a yes or a okay. All right, okay, okay. Okay, okay, perfect, perfect, great. So that's great. Okay, perfect. So I can see a lot of people. So that's great. I see a good amount of participation happening today. Please continue to participate. These are webinars. I understand being digital on the phone can be boring at times, but then let's try to make it more and more interactive. So without any further delay, let's try to understand what has been going on before we even move to the trading strategies. Let's just understand that why we need the strategy once and for all. Every investor is unique, and every investor takes their own investment decision. And let me come out and tell you this right away, that every decision you have taken about your investment, whether you have made a profit or whether you have made a loss, not necessarily the decision you took was always right or always wrong. Luck plays a really important part. Coming from someone like me who has spent 10, 12 years in the financial markets, I'm sure there are a lot of people here who had made a lot of money, lost a lot of money, probably spent a lot more time than I did in the financial markets. And all of them would agree this thing, that sometimes all your investment decisions are absolutely right depending upon the situation. But that but always comes in. Could be luck, could be market sentiments, we never know. Because all of us are raised in a different environment, under different parents, under different people, in a different economic phase. Somebody who was born at the time when inflation was not that high would never understand how to invest into a high inflationary environment, right? And that's why, with every economic phase, somebody who lost money in 2001 will never understand that why 2020 everybody got excited about the tech, right? Or somebody who's investing in technology stocks right now will never understand that why 2001 people lost money in a dot-com bubble, in a tech bubble. So the idea I'm trying to give you is that why we need strategy is because currently all of us revolve around different economic phases, grown and raised in a very different way with a very different investment mentality. So some of my clients, they only invest in the stocks of the country where they are from. So if I have my Indian clients, they're only investing in Indian stocks because they say that they only know those companies and they are from India, so they invest in Indian stocks. But when you see in further detail, you will know that they're not using any Indian products. If today you are using a Microsoft system, a Samsung or an iPhone, eating at McDonald's or a KFC, ordering from Amazon, using WhatsApp or Facebook or Instagram, or have a Netflix account, or if you have a credit card or a debit card which says MasterCard or Visa, travel through a Boeing plane, all of these are US companies, right? All of these are US stocks. So we cannot be ignorant of the fact that we are already invested into a lot of US companies, a lot of global markets. Might as well we should know about these companies, and might as well we should start looking for investment opportunities as well. Now, to give you a idea of what has happened in the beginning of 2022, because somebody asked the question that how we reached there where we are, and this is something. It's a bear market story. What has happened? What is expected to happen? Of course, because the beginning of the year, I should say, since the Great Depression, which happened in 1920s and 1930s, this year began with one of the worst starts we can have. And I'll show you a few charts, the first one which you'll see. But before that, let's just try to understand. We have seen a really brutal year so far, and September has come, almost 8, 9 months have come across. And as I said, that this year has been one of the worst years. If you see the amount of capital destruction which has happened. And when I say capital destruction, which means investors like you, investors like me, if I put money in stocks and stocks crashed, and if I lost money in it, that's the capital destruction, right? Around $9 trillion of value has been wiped off globally. And in financial crisis which happened in 2008, this was something which did not happen. The equity which has been wiped out in this particular year has been way more what we did in 2008. Somebody popped up the question: can we invest in Indian markets? You always can invest in Indian markets. Even through us, the directly stocks are not available, but there are funds which are available, which will give you exposure to Indian equities as well. And a lot of investors, they look out for Indian based funds and ETFs as well. So yeah, there is a availability of that. So coming back to how we have started, uh, most major stock markets right now, what we call them as a bear market territory. So bear is something, because bear attacks like this. So when the markets are going down, we call them a bear market, right? And this is, if you look at a normal bear market, typically an investment fall of, I should say, 20% or more from the recent high, we can say that market is in a bear territory if it has fallen down around 20%, right? If you look at crypto investors have suffered even more. The global value, I will come to cryptos also, and I will tell you the global value of cryptocurrencies, which have right now, currently, if we see, it is just above 900 billion. That's it. It used to be $3 trillion just late 2021, and now it has come down to $900 billion. And why it is happening? So somebody just popped up the question here that why we have gone through this, why this is happening, which are the trigger points at this moment. So one is all this talk about stagflation, right? Inflation we know, deflation we know. What is stagflation? Now when we talk about stagflation, that means economic growth slows down, but inflation continues to go up. Inflation means when things start getting expensive, right? So that is something which is a fear, that is it something which is going to happen? Will there be a time where inflation will go so much? Because inflation is 40 years high at the moment, which is the primary reason that why most of the stock are down, right? Because central banks have started raising rates. They are trying to cut down the demand. They are trying to cut down, reduce down basically the supply of money, and they try to sorry, they have increased the rates. So basically all they are trying to do is make sure that they rein in the money supply. They try to control the inflation which is going higher, and at the end, to prevent this carnage which is going on in financial markets. So that is the idea for a central bank when they are trying to increase the rates. How it affects the stock markets is that every time central bank increases the interest rates, stock markets, they start coming down. When inflation showed, the data inflation, when it went higher, we saw stock markets going down because everybody, investors anticipated that with higher inflation going, central bank will start increasing the lending rate, and that is where we will see the stocks coming down. So on that possibility, on that anticipation, the stocks go down. A lot of times, a lot of market researchers and investors, they say these things, that the stock markets move on the rumors, right? And when the actual news happens, it does not impact. So let me give you an idea. When I'm sure everybody must have heard about Brexit, the official referendum, the voting happened when the the people in UK, they decided whether UK should stay as a part of European Union or exit as a part of European Union. Now, when that happened, when the exit polls were coming out, the possibility that UK might exit from the EU, the moment that possibility increased, that was the point where we saw pound coming down, we saw global stock markets coming down, and the whole spiraling effort started. The news had not happened yet, the event did not happen yet, but only the possibility of the news happening, it already impacted the market. So what we need to learn, first of all, that whenever the likelihood or the possibility of the event is there, is when the market moves. But when the actual event happens, it will not impact much the concerned commodity or the stock. Why? Because that movement has already been priced in when the news came. So that's why they call buy the rumor, sell the news. Basically, whenever there is the possibility of happening an event, that is the most important time. Now, what has happened in the case of commodities, because the inflation is almost 40 years high and it continues to rise, we see back what we saw in 70s and 80s, the dark days, what we used to call as the great inflation, for example. And inflation has started going higher. The reason behind this is COVID lockdowns ended, right? But most of the major economies, the supply constraints were still there because COVID lockdown, that 3 months of lockdown, and then extended period where another variant came in, second wave came, third wave came, that has caused a lot of supply constraints, right? And that has happened in Asia, which is one of the most important continent when we look from the exports point of view. So there has been a lot of supply issues, but demand has continued to pent up, right? After the COVID lockdowns were removed. Also, I'm sure a lot of you must have heard about the war between Russia and Ukraine. So that has also started impacting. Now, when that happened, we saw supply constant due to COVID, and then the war broke out in Ukraine. And the result was inflation went up double digits. And the worst part is still continues to surge. I'm sure everybody who's living here or back in India or anywhere else, you must have seen the sudden surge in the prices of your groceries, the prices of your fuels, everything. And you see the cost of energy right now, the cost of fuel, it is up almost around 70%. Now, this affects from your production to consumption, right? But you look at the commodities across. So you look at this graph, look at the rise in the commodities. This is where you see that energy prices have gone almost 70% higher, just behind commodities. Look at sugar and coffee prices in blue. We have seen the rise in the commodity prices, and that is something, this is where the year started with. There's a question right now from one of our attendees. Are you looking market down overall this year? So, as of now, if I say industry and sector wise, technology sector specifically on the downside, a lot of tech stocks have already corrected. Nasdaq is down by 15%. So again, if somebody looks at a long-term perspective for the next 5 years, then you should not care about the fall. If you want to buy, you buy now, keep it for another 5 years. But if you ask me specifically this year, yes, there is an expectation where we might see equities getting corrected slightly more. S&P is down more than 7% year till date. Nasdaq is down more than 14-15% year till date. So this might continue for a while. But then even in the equities, few sectors are really important. So that is something which a lot of people ask, right? That which are the sectors which can improve, which stocks might perform best, which might perform worst. At this point, it's not just a recession investors are worried about. So a lot of investors, they are worried about recession, right? But recession is the last thing you should be worried about. Right now, you should be worried about the high inflation and what if economic growth doesn't happen. That will be the stagflation scenario where growth is very minimal, but inflation continues to happen, right? The only thing is in this particular era where you should invest. That's the main question. And every single time when something like this has happened, if I talk about stagflation, I talk about depression, defensive companies are the ones which have been mostly favored. Now, I am talking about that industry, guys. I'm sure everybody's aware about this. Defensive companies, when I say, that means those products and services which are very essential to people's everyday lives, right? For example, today, tell me, use your chat option, guys. Let's try to make it more interactive. There's a very significant event today. It's going to be happening in the evening, in few hours, in fact. What is it? You can even Google it. In this session, everything is allowed as long as you interact with me. Which is the main event which is going to happen in a few hours? Take a guess, or just Google it. You will find out. This is the only main event which is happening tonight. Happens almost every year. Use your chat options, guys. Tell me. Tell me. Okay. Started getting few answers. That's great. Okay. 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 Yeah, looks like everybody's on the same page. Nice. Nice. Okay. Okay. Anyone who has not found out which event is happening today, just write over me and I'll tell you what's the event. It's one of the most significant events. It happens every year. I'll give you a hint. It happens every September. If you use your chat options, give me the answer. I'll tell you. It happens almost every September, and it's one of the most watched events. And it also impacts the that particular, and it's a stock-based event. So if you search, I think a lot of you have answered this, which means it's actually really good. I'm sure a lot of you must be looking at this event also. Um, Apple event is happening today. iPhones, any new iPhones launched, any new MacBooks coming, Apple is going to launch a series of products. If you're holding stocks of Apple, it's an important day for you because that is where the stock moves, right? The stocks are going to move up and down. It will continue to go higher. Um, Apple event happens every September, okay, and every September they come up with their recent product launches. This time it's hyped about iPhone 14, but so it was about iPhone 13, iPhone 12, iPhone 11, right? But the whole point I'm trying to tell you is that this is going to be one of the most watched events, and this will affect the market, specifically Apple stock. Last time, when Apple launched iPhone 13 with 5G technology, Apple stock went down, but Verizon stocks went up. Verizon is a telecommunication company, and when the 5G technology picture came in the picture, the stocks went up by 5 to 6%. So yes, these kind of events matter. But the whole point of the conversation was that which sectors, right? So I'm talking about consumer defensive. Defensive sector are the ones whose products are very essential to people's everyday lives, right? Now, today's iPhone, if the iPhone 14 comes in, lot of the people under the current circumstances, when you know that things are already expensive and people are meeting end to end, and it's not easy to survive in a high inflationary market, you can ignore the new iPhone because you might need to pay the electricity bill. Now, I'm not referring to anyone specific. In fact, I hope that everybody here Touchwood is doing really good in their lives, and I wish it continues to happen. But this is the investor's choice, right? Should I use my 3,500, 4,000 dirhams to buy the new iPhone, or should I pay my electricity bill and save for the few months? If my electricity bill is 700, 800 dirhams, if it has increased, for example, 800, 900 dirhams, if I just save this 4 5,000 dirhams probably for the next 5 months. I can pay my utility bills, right? So this is what the investor choice is during the high inflation time. So rather than investing in an Apple stock, you can invest into Diva stock, or let's say any consumer utility, power, electric companies. These are the products. Recession or no recession, they will always be favorable, right? So that's why at this moment, when you ask me the question, am I looking the markets overall down this year? Yes, slightly on the downside because the interest rates continue to go up. But few sectors, if you focus, there have been statistically proved that during the stagflation times also, sectors like consumer utility, like electricity and power, they have really worked well. Consumer staples, I should say, that is also something which has really, really worked well, right? So shares of defensive stocks, they hold better when the economy starts slowing down. Only exception normally is the energy stock, right? Because energy stocks are naturally tied to energy prices. So, and if when you're looking at inflation, you're looking at energy prices, it is determining the inflation. So, by the definition, energy stocks should perform well if the inflation goes up, right? So, if I put it in very technical terms, these kind of defensive sectors, uh, when the market moves, they are very less volatile, right? They're very less fluctuating. They have mostly if market, if the inflation is going too high, defensive sector will be most favorable. And otherwise, of course, as I said, sectors like energy. Now, if inflation is going up, oil prices are going up, then energy stocks like ExxonMobil, British Petroleum, Chevron, all these kind of companies are expected to go up due to high energy prices. So, uh, consumer defensive sector, energy sector are something which you should allocate. I mean, from a consultation point of view, should be viewed a lot. Uh, Another, if you see from sector wise, again, technology sector or consumer leisure, expensive products, those kind of sectors may not perform well. Somebody said US market index going down. See, on daily basis, index is going down. You see US 30, you see Dow Jones, they're going down. I'm talking about very specific stocks. If you're looking from an investment point of view, right? And if you have investments in the area, or if you're looking to buy some shares, see, you cannot always be out of the market because you will never be able to catch the bottom, right? How many of you actually think that you'll be able to catch the bottom? Who entered into the pandemic when graph went down, and then when there was a V-shaped recovery? Who was that one person who was at the bottom of the V, right? I wasn't there. I know I wasn't there, to be very honest. If somebody was, then very good. But then you always are supposed to be invested. You have to invest somewhere. So try to shift your sector from tech to consumer utilities to energy or any other defensive sectors you see. So this is the story for commodity prices. Look at exactly what I was talking about. What has happened in 2022? A lot of you have specifically said out that US indexes are going down. Bearish market has happened, which has happened. I mean, no major stock market. You talk about India, you talk about US, you talk about Europe, you talk about UK. No major stock market has left unscathed, right? Because the worry for investors at this moment in stocks is more persistent and more inflation continues, right? More drastic central bank is going to take measures with it, right? If central banks they do not manage this thing properly, then it could lead to stagflation, lower economic growth, high inflation, high unemployment. But the whole point is that that is going to affect the stocks. And that's why consumer defensive is one sector which you should always be looking at, because not only the volatility is less in that sector, but also a lot of companies they declare fixed dividends, right? In this kind of an era, you need a stock with a good dividend. So always look into it. And that's why we are looking at from US to China. If you see, look at this chart, what I'm showing you to you from US to China. Look at all these different indices, the world indices. From developed economies to emerging, most of the stock markets are down more than 15%, right? And a lot of them have already crossed 20%, which is an official bear market, if I call it, right? So yes, that is something which is happening at the moment. You look about the next cryptocurrencies, for example. How many of you have invested in cryptocurrencies or bought cryptos through different platforms? Just write yes on your chat. Keep you interested. I mean, I did. Um, Still bought Bitcoins. Didn't want to be on the side where Bitcoin goes up, and I don't want to be a part of it. Okay, two, three, four, five. Exactly. See a lot of investors here. I'm sure not just Bitcoins. Few of you must have bought Ethereum. Few of you must have bought Solano. Yeah. So a lot of you I see have bought cryptos, right? Now the whole point is, even look at the whole bear market story. Even Bitcoin fell down, right? And it did not just fall down. Look at the cryptocurrencies perspective, like especially in the environment where we are in right now, riskier the investments are, harder they fall. Please remember this, that whenever you get into this kind of environment where the stock market's already bearish down, the central bank is hell bent on increasing the rates, inflation is high, more riskier assets you are in, harder they will start falling. And cryptocurrency market at this moment has fallen most. So if you look at the global crypto market, two-thirds of its value, if I think exactly around two-thirds of its value since last November, if you compare, it has happened. And most of the losses, even after March 2022, we have seen most of the losses were sustained because Terra USD stable coins like Terra, which was supposed to be pegged with dollar, that also fell, right? It even broke the whole investor confidence. And now it's one cent. So people used to talk a lot about stable coins. It is pegged to dollar. Nothing is going to happen. That Terra coin is now 1 cent. So even the pegging mechanism did not work, right? And that particular cryptocurrency had a ripple effect on the entire crypto market. Bitcoin, which was at $69,000, all time high, now it is around 20,000, 18,000, right? How much is Bitcoin right now? Anyone? Use your chat option to write it. What is the Bitcoin price currently at the moment? Use your chat options to write it. What's the current price of it? 18,500. Real quick. Perfect. 18,500, right? From 69,500. As an investor, how much you are going to hold? What sort of patience you will have, right? Bought one Bitcoin at $70,000, holding on to what? 20,000. So this is something also, again, guys, which has happened. We have seen crypto markets falling down, and ripple effect after Terra went down, and we saw global crypto market. It has gone down, right? So now, coming to the point, what sort of trading strategies we should look at? Now, I have gave you a brief of what has happened in 2022. Now, all of you are very much aware of what has been the condition of stocks, what has been the condition of cryptos, commodity prices gone up. We have seen a lot of movement happening in commodities. Indices are all the way down. We've discussed about which are the sectors which can still be favorable to invest in terms of stocks. So consumer defensive sectors, utility sectors, talking about probably telecommunications, and then we talk about other part of this thing, which is energy, because oil prices are going all high. So it's like an exception, but yeah, energy stocks. Now the idea is, how do I invest into such sort of volatile markets? So a lot of you have asked this question, and we talk about this. One is your regular investing. What you do, you buy a few stocks, you hold on to it for a period of year. If you see a substantial profit, you get rid of those things, book a profit, get out of the market. Another is when you start investing into real estate, right? The only difference between a stock and a real estate, when you own, it's about liquidity. You buy a stock now, tomorrow it goes up, you can sell it, get out of the market, you cash in your investments. With real estate, you tend to hold on to long time for it. Plus, again, the trend. Uh, for the longest time, we saw real estate prices dipping down for the number of years, and then again started going up, right? Different events happen, and then again we'll see a certain downside. So the only point is the time where that sector is down, your money is blocked, right? Obviously, you can do a lot of things. You have a physical asset in your hands, and nobody beats that argument. But yeah, those are the trading avenues. You invest into stocks, you invest into real estate, because in a high inflationary environment, Only stocks and real estate can normally cope up. Bonds at this moment, if the bond is not linked with the inflation rate, then honestly it doesn't serve any purpose, right? So what we are looking at right now is that do these two, three avenues, which are your traditional conventional form of investments. There are not many IPOs happening at the moment. So at this moment, I'm not sure how many of you are investing in IPOs. Not a lot of IPOs happening, not considering UAE market over here, but talking mostly about the entire globe. So comes to the point where we can start looking for another part where a lot of you will trade, buying, selling, putting stop losses, right? Which is rather, again, a speculative way to reach out to your investments. And that is the most riskiest investment. I see a lot of clients, they put money, they buy gold, they put stop loss gets it. Few people make money, few people lose money. But at the end of the day, trading is a risky game, right? If we don't follow the rules, we don't follow the discipline, we see the portfolio is going down. What I'm trying to present you over here is share your view on dollar index. I will, sir. After this, I'll definitely share my view on dollar index as well. The dollar index has been going to its highest level, I think around 107, and I think it is something which has I've never seen dollar index so high. But this is a high inflation rate environment, so yes. Coming back to the trading strategies, now there is something which exists from the longest period of time, and a lot of hedge funds and a lot of fund managers they use these kind of strategies. Something called a statistical arbitrage or a pair trading, right? And this is very easy. Of course, in one session we cannot cover the entire the structure of the strategy, and that's why after this session, whosoever has attended the session, I'll be available one on one any day, any time of yours, uh, without any commitments of account opening or anything. You want to come learn, understand the platform, just because you have taken time out to attend this webinar, I'm more than happy to have a one-on-one session with you people, and we can definitely discuss more about this. So how pair trading works is it's very simple. It's one of the most popular strategies, when it comes to finding a trading opportunity, right? Because normally we see people buy one side and they put a stop loss, and if it works, it works. If it doesn't, it doesn't. But there are a lot of asset classes which are co-integrated. uh, Tell me, use your chat options. If I say Pepsi, which is the next company similar to Pepsi comes into your mind? If I say Pepsi, the very next same company, different name, which is it? Use your chat options, guys. Use your chat options. When I say Pepsi, which is the next company comes into your mind? Okay, okay, okay. I think definitely we are on board with it. Everybody thinks the same way. Similarly, when I say MasterCard, which company comes to your mind? When I say MasterCard, exactly, perfect. I mean, absolutely, there is no other way that anybody can think other way. It's different. I say MasterCard, you think of Visa, right? I say Pepsi, you think of Coca-Cola. Similarly, pair trading works with these kind of companies. So there are a lot of stocks which are kind of co-integrated. They have the same regulatory environment. They have almost the same target market, same products. And pair trading strategy is all about how to take advantage of this co-integration, what we see, right? And normally, how the pair trading will work, a pair of stocks, it is traded, right? We also call it a market neutral strategy. It's a technical term, so I don't want to, bore you with the technical bit, but it is called market neutral. Basically, the idea is market could go up and down, but your investments will not get impacted by the market movement. So the market risk is less as compared to the trading and speculation. So we established this one, right? It doesn't matter where the market is trending upwards or downwards. You open two positions for each stock. Okay. So let's say select a pair. Okay. Let's say you select a pair of MasterCard and Visa, right? Now, MasterCard, you buy MasterCard and you short sell Visa. Now, before I go any further, let me conduct this quick poll to understand. Do you know about short selling? Because a lot of strategies are based on this. Yes. No. Okay. 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 So there's a poll running right now. Please use this. So on the basis of this question, I would be able to proceed further. I want to know how many of you know about short selling, how many of you don't know about short selling. So I'll just give you a quick explanation of this and I'll tell you because the entire pair trading is based on your understanding of how short selling works. So if you understand that, this strategy is a piece of cake for you to understand. Okay, so perfect, perfect. I think it's a 90-10 ratio basically. So I'll give you a quick explanation. If you don't understand, meet me one on one for the discussion. I'll definitely make you understand this. So a lot of you already know. I see a lot of you already know. Around 80-90% of the people here, they already know what short selling is. For those people who are not aware about it, short selling is a way how you make money from the falling prices, how you take advantage of the falling prices. Today, I know the price of the bottle is $5. If it goes to 10, I will sell it at 10, I book profit. But what if the price of this bottle is $10 already and I'm expecting a downside? So what I do is I borrow this bottle from a store and I sell it in the market for $10. I receive $10. After a few weeks, as anticipated, the price of the bottle drops. So what I do, I go into the market with this $10 which I got when I sold this bottle. I buy the same bottle instead of giving 10, I just give $5 because price has dropped to 5. So I had $10, I gave 5. I kept 5 with myself, which was my profit, took the bottle back and gave it back to the store. In the entire transaction, I borrow from the broker, sell it in the live market, and when the price drops, you buy it back at a cheaper price and give it back to the broker, the stock, the price difference you keep. Now, obviously, the risk is that if you borrow something and you sell it in the market, you are expecting price should fall down so you can buy it cheaper, keep the price difference, and give back the stock to the broker. But if price instead of going down goes higher, then you're in a loss because you borrow it from the broker, you sold it at $10, and now when the price has become 20, you are in a loss because if you end up buying this to give it back to the broker, you will pay more than what you sold it for. So short selling works in a very simple way that you borrow the stock from the broker, sell it in the market. If the price falls down, you make profit. So in short selling, we make profit from the falling prices. In buying, we make profit when the prices go up. So that's why a lot of people they use these online trading platforms because they can not only take advantage from the buying prices, they can take advantage from the falling prices also. Now, how pair trading works? We find out two co-integrated stocks like Pepsi and Coke, Mastercard and Visa. We buy one and we short sell another. Now, the moment that happens, because both of them are stocks, right? Both of them are companies, they have similar products, they are very much integrated. So normally their prices will move in the similar direction. So when I buy one and I short sell another, if the stock market starts going up, so Pepsi prices will go up, Coke prices will also go up. So I'm making profit in Pepsi, but I'm making a loss in Coca-Cola because I have short sell Coca-Cola, right? So this way, if market falls down, Coca-Cola will fall down, Pepsi will also fall down. So I'll be making a loss in Pepsi, but I'll be making a profit in Coca-Cola because I'm short selling Coca-Cola. So the idea of a pair trading is to buy one asset, short sell another similar asset. Now the question comes in, how do the investor makes money out of it? If you buy one and short sell another, basically market goes up, this goes up, you book a profit, but this also goes up, so you make a loss. How do you make money? So that's why, how do you make money? You make money on, you see this gap, you make money on the difference. I'm going to share 3 to 4 strategies with you to make you understand this, how this will work. So you make money on this gap because sometimes what happens, the rate at which Pepsi will go up will be higher than the rate at which Coca-Cola will go up. So Coca-Cola will have, the position of Coca-Cola will have a small loss because of short selling, but the buy position of Pepsi will yield you more profit because this gap between Pepsi Cola has increased now, which is called a spread. trade or a spread arbitrage also. How people make money in statistical arbitrage, that they compare the difference between Pepsi and Coke. Today, if Pepsi price is say $50, Coca-Cola price is $49, and the difference is $1. Tomorrow, this difference can go higher. What if Pepsi earnings are way better and Coca-Cola earnings are bad? So you buy Pepsi, Pepsi earnings come out good, Pepsi stock goes up, you book profit. Coca-Cola earnings come bad, it goes down, you book a profit here also. So this is, you made a arbitrage profit in both of them. Mostly how arbitrage trade works, or how a statistical arbitrage trade works, one of your position is in profit while other is in a loss, but the one profit which you have exceeds the loss from the other one. So the idea of when you enter, when you exit from the trade, that entry and exit, when the consultant over here speaks to you, they tell you that what is a decent time to enter, what is a decent time to exit. And I'll share a few strategies with you, and I'll share the risks also with you. No strategy comes, it's not a risk free arbitrage. The risk is always involved, and I'll explain you how the risk works. But this is a basic concept of how a pair trading would work. You identify pairs like Pepsi, Coke, MasterCard, Visa, right? Walt Disney, Comcast kind of pairs, or gold and silver, for example. Precious metals, if gold prices go up, silver prices also go up. Maybe not at the same percentage, but the same direction, right? So there's the arbitrage goes on between gold and silver prices also. Why these kind of platforms? Because you can, on these platforms you can buy one and short sell another. So that's why there are opportunities which happens. And exactly, normally in inflationary environments where market is so volatile, where you cannot see where market is going, a pair trade, a market neutral trade is normally which protects a lot of portfolios. And hedge funds, they try to use these strategies, which I am right now sharing with you. There are a lot of 3 4 PDFs which I will share it with you. All right, so that is one way. Then there is something called seasonality analysis. Now, seasonality analysis is, I'll show you a heat. So, seasonality analysis is basically understanding a historical pattern of one commodity and looking at that pattern, taking a decision whether to buy or sell. Give me this answer, and I'll explain you how seasonality works. Use your chat options. If you want to call someone to Dubai here to stay here, say your family, your friends, anyone, they say that we want to come to Dubai, which month you will prefer for them to come and enjoy Dubai? Use your chat options. This is the exact example of a seasonality trade, how seasonality trade would work. If you have to call someone, or if a friend of yours wished to visit Dubai and ask you which month should I come in, which is that month you would prefer? Start getting answers already. Okay, okay, okay. Take guess. Obviously, there's no right and wrong answers to it, right? So go for it. Go for it. Whatever you feel. The most important part is that we are interacting through this web session, which is really great. So, so a lot of you have already said November, December. Somebody said December. Somebody said November, November, December, November, December. Most of the votes, November, December throughout, right? Those who are not voting at the moment, I'm sure you agree with it. November, December. How do you know November, December? Because you have seen years over years that November, December is a pleasant weather I can enjoy. But tomorrow, if you call somebody in December and if the heat waves comes in, whose mistake is this? It's not your mistake. It's not your friend's mistake. That is where the strategy goes wrong, right? But what I'm trying to tell you is that there are seasonality analysis which we do. So let's take example for let's say natural gas. For example, I'll try to show you a PDF of natural gas. Is it here? No, not this one. Okay, I'll show you an example of a seasonality trade, and we'll do it. So what we do is we go decades ago, 10, 12 years of understanding. Every year, every month, we compare the monthly performance. So we see that in last 10 years, if January has been the most positive month for that commodity, I would tell you that buy this particular commodity in the month of January. If I see that from September to December, this commodity has performed always better in last 10 years, that is a seasonality trade which we are taking. So seasonality is not easy to identify. You have to get a good pattern to take a seasonal trade. If I tell you in last 15 years, February has always been positive of natural gas, and February comes in, you will be inclined to buy in the month of February because I'm giving you 15 years, every year on year, every month of February is positive, right? Again, it's a hypothetical example. We'll see more examples of that. But that is what a seasonality analysis is. Seasonality analysis still like a speculation, right? It can be right, it can be wrong. But the point is, rather than taking a random trade, what if you know the seasonality pattern of the commodity, right? So you demand that, you ask that, you research that, and that is something which will help you out in taking your investment decision. Okay, I'll show you an example of seasonality very soon, followed by interest earning ideas. Now, interest earning ideas, instead of interest, I should say it's more of a interesting earning ideas. Okay, so interesting earning ideas involves a quotient of a holding cost. So in platforms like the platforms which are derivative based, when you buy a commodity or an index, you pay a certain cost called holding cost, because a lot of these providers, they are leveraged providers, which means they allow you to take positions more than your investment, right? So when you do that, they charge you a holding cost over the facility of leverage which they give you. Similarly, when you short sell something, you receive that money in your account, because when you short sell, you sell it at the market price. There is a certain amount, hypothetical, which would be put in a bank and you would earn that kind of, right? So in a short selling transaction, you earn a holding cost. Again, it's a very technical subject over here. So those who are not aware about holding cost factor in CFD platforms or derivative based platforms can talk to me after the session or later on, and then I'll explain it to you. But there are strategies built around this also. Now, the idea is, let's try to understand one by one how these strategies would work. Okay, so I'm sharing you the first strategy. Before there are 3 4 strategies which I want to share it with you, and I'm sharing the PDF with you. Now just look at this very closely. Okay, hope everybody can see this. If you can see this, please write yes on your chat screens if you can see the PDF which I have shared it with you right now. So wait, this I'll just stop sharing for a moment. Just give me 1 second. This is fine. Yeah, here, sorry. I want to share this strategy with you. Okay, now you should be able to see this properly. So this is a strategy called S&P mid cap and Germany mid cap. Okay, it's a pair trade strategy, and let's just try to understand what we are doing here. This is the first strategy before we end this session, right? So we have 3 to 4 strategies to discuss, and this is the first one we are going to talk about. S&P mid cap. What is S&P mid cap? S&P 500 is an index. Okay. What is a mid cap? Mid cap are those companies whose market value is not too high and not too low. It is in the middle. That's why it is called mid cap. Every company, every country has their own definition of mid cap. So while the trillion-dollar companies are these mega cap, large cap companies, something between 2 to 50 billion will be a mid cap company whose market value is 2 to 50 billion will be a mid cap company. S&P mid cap is a US index. Germany mid cap is a German index. I am looking at now US and Germany. The pair I'm trying to establish is between US and Germany, right? This should be clear. Now, let's understand the strategy. What is the rationale? What we have to do is we have to buy S&P mid cap, okay, and we have to short sell Germany mid cap with equal exposure. So today, if you have $20,000 with you. $10,000 if you were to do this strategy, $10,000 buy S&P mid cap, $10,000 short sell German mid cap. Okay. Again, guys, I'm whatever I'm telling you through these strategies, please, until you discuss it with your risk consultant, until you fully understand the risk behind it, please do not execute these trades in your live account. There are a lot of demo accounts, practice accounts. Practice first before you do this, or talk to your risk managers and consultants before you do this. Okay, this is not a recommendation. This is only for information purposes. So please understand this first, right? Now, what is the rationale? You buy S&P mid cap and you short sell the Germany mid cap. Okay. The reason behind this, first of all, the US central bank, as we have discussed, is expected to increase the interest rates, right? And they are going to continue until it reaches to a point of 3.7 to 4%. European central bank, because inflation is global, right? So US has already started raising it, but the European central bank has increased it only by 50 basis points, 0.5%. That is all. And European Central Bank is expected to increase it more, expected to further increase it, which is going to affect the European stocks more, right? So there are a lot of traders who are still uh, betting on the European stocks to fall down, right? The September is a very important month, and that's why we are sharing this strategy with you at this moment. That European Central Bank is expected to increase rates more in a higher capacity. US has already been doing it. So the impact on US stocks and on European stocks is completely different. European stocks are expected to fall down further as compared to US. Also, what is going on with US at the moment is right now Europe is trying to reduce their energy demand because they don't want to rely on Russia for the gas, right? Now, for that to happen, they have to at least reduce the demand by 15%. And European gas prices have gone up $400 per barrel. And normally, this is a low demand, right? So now winters are coming. Climate change is real. It is impacting different parts of the world. Everybody has seen heat waves in UK and different parts of the world. Now winter is also coming, which means that the weather changes are very extreme. Okay. So when there is winters, there is a lot of winters. When there are summers, there are heat waves. So we're expecting a winter again in Europe, which is going to strain Europe further before they can try to reduce the demand. And they will still continue because Europe's ban on Russia crude right now, it has already happened. And Eurozone is going to be again being tested when the winters comes in. When it comes, so there is a lot of energy crisis. Inflation continues to be the same because energy prices continue to go up, right? Because their sources are very less to bring oil from. And that's why the physical market is tight. Climate issue is still a process. It's difficult to get energy supplies, and that is why inflation continues to go up. European Central Bank has to raise rates in order to avoid recession, right? It has to increase, it has to lower the demand for the products, and that's why it is needed that the Europe has to continue increasing the rates. Now, if recession comes in, which is for Europe is the best case scenario, it is still going to affect the European stocks, right? So there is a threat of a recession which is expected because if you see the economic growth numbers have been revised from 4% to 2 to 1, and now it's very less. The fundamentals are also keeping on the edge. The manufacturing index in Europe is still very low as compared to US. European labor market is way worse. The US labor market is still better. If you have seen the non-farm payroll reports, it is still better. And the Russian-Ukraine war, as you see this in PDF, the Russian-Ukraine war is not going to affect US too much, but more to the Europe, right? So under these times, now what you will do as an investor? Would you invest into US markets with what I just said? Or would you invest into European markets or short sell European markets? Or you could buy S&P 5 mid cap and short sell European, right? So tomorrow if stock markets start going up, you have one leg which is going higher, And if if the market's going down, then US also comes down. You have loss in US, but Europe will also go down. You might have profit. So the rate at which both markets will move is the deciding factor, right? So and again, look at this. This is something really interesting. This is not a price chart of S&P or German mid cap. This is the price chart. This is the ratio chart of both the prices. So you look at S&P mid cap divided by Germany mid cap prices, you will get a ratio. This is the chart of that ratio, which you can see that it is expected to go up. Looking at the current chart, it is breaching that barrier of resistance, which means the ratio will go higher, which means S&P prices should move higher or German prices should go down for this ratio to go higher. This is the assumption on which the pair trading works, right? Now, as I said, the rationale is very simple, but there is a risk, and this is the risk. The risk is this whole strategy is based on the fact that Europe is going to go through a further energy crisis. Okay. And European Central Bank is expected to increase the rates, and European stocks are going to go down further. But if magically the Russia-Ukraine situation resolves, then there will be a favorable scenario for the Eurozone. Okay. Then this strategy will not work. So we have to understand the risk. This is exactly meant for the current times, right? That if it works for today, it is going to work in this scenario. But if it doesn't work in this scenario, if the Russia-Ukraine issue resolves, then this strategy doesn't work. So these are your risks and reward. Every arbitrage, every pair trading strategy will have this kind of risks and reward, right? Moving on to second strategy. So as I said, I'm going to share it with you different strategies, right? So let me show you another strategy which is here. Let's say, okay, right here. Share screen. And okay, so let's go for, okay, look at. So as an investor, that you should know there are two kinds of coffees, by the way. I mean, Starbucks, Costa Coffee, that is one thing. But even in Starbucks, there are two kinds of coffees globally which is used. And one is called coffee Arabica, right? Another is coffee Robusta. This pair strategy is about coffee Arabica, okay? And this could be a normal coffee bean which you are drinking in Starbucks. So just the name. Second is cocoa, which is basically the source of chocolate, okay? So now this time we are doing a pair strategy between coffee and cocoa beans, which are the from which the chocolate is made of. Arabica coffee, world's most popular type of coffee, 60% of the global coffee market. Origins, Ethiopia, beans transported to Lower Arabia, the variety of coffee, slightly sweet flavor with pinches of chocolates, nuts, caramel. This is, again, guys, you want these PDFs, we can share it with you later on. Most of the brands we see in grocery stores, cafes, bars, they have Arabica coffee. Always remember it. So next time when you are sipping a cup of coffee in Starbucks, most likely it is going to be coffee Arabica. Okay. Now, cocoa beans, they are the primary ingredient for making chocolates. And cocoa beans, they come from the tropical climates around the equator in South America. Superfood, antioxidants, mineral nutrients, everything. Now, what is the current market cycle going on with both of these commodities is what you have to understand. The cocoa market, which is the source of the chocolate, it is expected to turn from a deficit to a surplus next year. Okay. And it is in the season on the back of growing production in Africa. World's top grower of the chocolate making ingredient, Ivory Coast, it is growing a lot of production. So the production in cocoa is expected to increase. The countries like Ghana, for example, output is going to come from them, one of the largest producers. Then there's a potential for a further price hikes and gains in the commodity is limited by this year end. So because of the oversupply, because of the excess supply, earlier there was a deficit in the production, but now there is surplus. So we are expecting on the basis of these fundamentals that there is very less potential for the price increases for cocoa beans until the next year. On the other hand, when we see the Arabica coffee prices, we have seen a very upswing because there has been supply concern. And Brazil is the world's largest producer of coffee. And there has been a dry weather, and which has always remained a concern for the agro-based commodities, the weather conditions. And because of the dry weather in Brazil, we have seen the supply of coffee. It has got affected even after heavy rains. We have seen earlier this month there has been in some areas, but then again stronger weather conditions are expected to affect the crops. And that is the reason that why when you see Brazil, when you see Vietnam, the coffee production is expected to get impacted and the prices are expected to go high. So basically the strategy is very simple. You buy coffee Arabica and you short sell cocoa, expecting prices to come down. Now what we did was, I told you that it is a statistical arbitrage, the pair trades when we talk about, right? So when we talk about statistical arbitrage, we look at the numbers also. Now, when you look at the numbers, you will see from 2015 to 2022, if you see profit and loss of just coffee, so every single time in, like for example, 2015, coffee showed a negative return of 23%, cocoa showed a return of 16% negative. Coffee showed a positive return of 9% in 2016. Cocoa showed a positive return of 23%. Coffee in 2017, negative 8, like this. So if you see individual returns of both coffee and cocoa, there is no pattern to it, right? There is no pattern to it. If you had only invested in coffee, you will be speculating. If you only invested in cocoa, you will be speculating every year, depending on weather. But if you had used this pair, you bought coffee and short sell cocoa. Now look at the returns from 2015, and this is the extreme right corner. Look at the strategy, extreme right corner. That if you see the PNL of the pair, that if you buy coffee and short sell cocoa, except 2015 and except 2018, most of the time we have seen positive increases, right? And when I say positive increases, look at the numbers. In 2015, this pair showed negative 39%. After that, positive 32%. After that, 12%. In fact, in 2017, coffee prices were down. Okay. Cocoa prices were up. Still, we saw a positive 12%. Then, if you see, minus 48%, but after that, 25% plus, 3% plus, 79% plus, and in 2022, as of now, 2% plus. So a hit ratio of this strategy is around 70 to 75%. But again, guys, as I said, either you can buy, sell cryptos and commodities and do whatsoever. With strategies, you have to understand that this is based on certain calculations. The only thing is that these are not risk free. Tomorrow, if for some reason cocoa prices start going higher way more than coffee, then your strategy is reverse, you lose money, right? So as I said, that what I'm trying to share over here is a historical pattern. So that's why always I'm sharing you with the historical pattern of a strategy and how it has performed back in the past, so you can take an informed decision after calculating your risk, right? I'm not sure how many of you knew these kind of strategies existed, because mostly people feel that okay, we are trading, we buy something, keep a stop loss, and that's it. But no, there is more to it. You can actually do a lot of arbitrage in these strategies, especially in markets like now, where you don't know where the stock markets are going. So these are your long-term investments, your real estate, your bonds, your stocks, and then a small part which with which you normally trade. Rather than trade, you use that money in strategies, right? You still take a significant amount of risk, but the odds could be in your favor, right? Again, odds could be in your favor, but there is always a risk. So until you understand these, please don't do it. Talk to your risk managers and consultants and only then do it, right? Similarly, there is one more strategy which is going on with the bonds also. So instead of just buying simple bonds, what you can do, let's say, I'll show you right here. Um, Before I just end this session, guys, I think this is going to be the last strategy before I share it with you. Look at this. Now, this one is about bonds, US bonds, German bonds. We all saw how stocks in US and Germany are going to be. So I gave you a pair trade for that. Now look, if you are looking for bonds, how you can look into a pair trade for the bonds. So US 30-year bonds are called treasury bonds, right? They are available on the platform. Then there are Germany treasury bonds, which is called Buxel. The strategy is you buy US bonds and you short sell German bonds. Reason being, again, as I said, right now the US central bank has raised the interest rates, okay? But the terminal rate, what US is, what is the terminal rate? Terminal rate is like the ideal rate which central bank wants to have, where there will be growth also, there will be control of inflation also, equilibrium point. So that ideal rate is 3.91%. Currently US is at 3.49%, very close to the terminal rate which they want to achieve. Okay, now if we see from Europe, specifically German point of view, their terminal rate should be 2.3%, it is only 1.2%, which means Germany is still a long way to go till they reach their terminal rate. Okay. So whenever the interest rates will go up, the bond yields, the German yields have a lot more room to go up as compared to the US bonds. Now, one fact which we should know, that the prices of bonds and the yields are inversely related. Okay. Yield only increases when the price is down, because yield is the total return of a bond. To make it very simple for you, a total return of the bond is a yield. So when the price is down, right, and the coupon is still the same, at the end of the day, if you have bought at a discounted price, you will still redeem your bond at a normal par value, right? So your yield will increase. So that's why if the price of the bond is down, yield goes up. So if you're expecting German bond yields to go up, which means the price will fall, that's why you short German bonds. And US bond yields, because it's very close to their terminal rate, so we don't expect any excitement in the bond yield market. It's not expected to go any much higher. That's why you buy the US bonds, because lower yields means prices are up. So US bonds, we are not expecting yields to go by too much. It has already grown up. It's very close to the terminal rate. So you buy the US bonds. The German bonds, because yields are expected to go up, so the German bond prices are going to go down. So that's why you short sell German bonds. So this is a strategy again, what we are looking at, right? So, guys, the idea of the matter is that there are a lot of strategies you can work around with. Okay, there are many times before we leave, just in stocks, something very important which you can know during your earning season, and this is going to help you a lot. Just look at this. Anytime before the earning results comes out, always try to have this research with you. This is called price action analysis. Okay, so let's say Starbucks earnings was there on 3rd of August. Okay. Now, what we did, because it was third quarter earnings, we did a analysis of last 10 years of Q3 earnings of Starbucks. That if somebody enters a day before earning of Starbucks and exits on the day of earning of Starbucks, historically, if you had done that bought the stock before the earning comes in and exited after the earning comes, what will be your total return in last 10 years if you did it every third quarter? You can clearly see over here, guys. See, this is important to know. Between 2012 to 2021, every single time, if you buy Starbucks on the day of earnings and hold on to it, say for the next 2 weeks, most of the times the returns are negative. The average return for Q3 earnings, if you buy the Starbucks stocks on the day of earnings, hold on to it for another 2 weeks, the returns are negative, right? Probability of gain in price only 10%, which means maximum drop you have seen 5% in last 10 years, average drop is minus 2%. So if I want to invest in Starbucks for 2 weeks or something and earnings are coming, looking at that chart, I would mostly short sell Starbucks and not buy it, right? This is something what we call as price action analysis. Again, guys, as I said, With Century, there are a lot of consultants who are available. They can assist you on these kind of strategies. And as I said, the mention of these strategies is not so that you can start your live account right away and expect to make profit out of it. Like this, there are a lot of strategies which change depending on your risk appetite, which change as per your objectives of investment, and which change as per the market. Okay, there are a lot more strategies like this which we have created, and we are more than happy to have a one-on-one session with you, share it with you, explain it to you. And if you feel that this is your cup of tea, only then do it. Okay, this is not one of those things that you fund your accounts and then we'll do it. Nothing like that. You're most welcome for a one-on-one session. We'll show you these strategies, how this works. Why don't you try this on a demo account? Any relationship manager you're connected with on the team of Century, ask them for a demo account, ask their help for the demo account, and try any of these strategies in your practice accounts. This is practice accounts are the best way to make yourself familiar with the platform and test a strategy. You will never know whether you're going to make profit or loss in a demo account, because demo account, the practice account, and live accounts are very different. It's a different sentiment, right? But using a practice account helps you understand that how to execute a strategy and helps you to keep a track of it without investing a single penny of yours. So that is something which I wanted to share it with you today. And all of you have been very interactive, and all of you have participated amazingly. Please, if you have liked this session, review us on Google and Century Financial. If you want to improve something about the session, let us know. You want to book a one-on-one training session, I'm available. Please reach out to your RMs, and they will definitely fix a session for you. There's a question over here about how can we get a demo account. Demo account is easy. Just speak to your relationship managers, and they will help you out. Definitely, they will help you out, and they will provide you one. It's free of cost. Even the trainings are free of cost if you want to come and understand, and will definitely help you out on this. Right. Again, somebody asked me during the session the view on the dollar index. I think that is also something which we quickly will discuss about it. As of now, I think this 110 levels, as I said, I've seen very rare. But then again, it's a high interest rate environment, so dollar index is still on the higher side. It has still some initial resistance, but the view is still on the upside. I think because it has already crossed that support, that line which was around 105. 105 is a very strong support. So even from 110, if it comes to 105, I think still going to bounce back. On the upside, I feel that next barrier could be 112 and 113. That is something which could be your barrier. So 113 right now, the long term scenario is still on the upside. The moving averages, if you will see on a technical terms, is still on the higher side, and 112 is the new next scenario. If it crosses, then again. But on the downside, 105 is a very very strong support which you can hold on to. Right. So once again, guys, thank you so much. We'll meet next week again with a different topic. If you have any questions, please shoot. If you want to meet me one-on-one for a session, I'm more than happy. Please review us on Google. Let us know how we can improve on our presentation, how we can improve on our webinars. Do talk to us, talk to your RMs, get a demo account. If you want access to these strategies, these are available. Talk to your RMs, they will explain it to you. Even if you want help executing them in your practice or demo accounts, we can help you with that also. Right? Just try it out, and this is something new which you will learn. We do a lot of more sessions on sustainability investments, responsible investing, and like a lot of sessions. We do a lot of investor education weeks, which are 6-7 days stretch sessions, and we want to help you out, assist you in understanding what's going on. Right? So thank you so much once again. We'll meet next week with a different topic. Till then, please stay safe. I always do this before the session ends. Anyone who is a doctor or first responders or health workers who have risked their lives during the pandemic and still continue to do so, a big word of thanks on behalf of my team in Century, my family, myself. Guys are doing a great job, and I wish nothing else but the best of the health to you. If you have your friends, your sons, daughters, spouses doing this job, my big word of thanks. And we'll meet again next week. Thank you so much. My name is Yogesh. Have a great night.